I'm Francine, Lacqua, and I couldn't be more happy to bring you this panel on investing for a new age. So we're speaking to two top investors really to try and figure out the global market outlook for the year ahead and beyond. I couldn't be more happy to now welcome to the stage His Excellency Mansoor bin Ebrahim al-Mahmoud, Chief Executive Officer at the QIA, and Stephen Schwarzman, Chairman, CEO, and co-founder of Blackstone. So gentlemen, thank you so much for joining me. We have 24 minutes to figure out the investing landscape in the next year and beyond. So a very simple and difficult question. Your Excellency, how has the pandemic actually changed the way you look at investments going forward?
Of course, the pandemic has changed the landscape of the investment. As you know, during the pandemic, a lot of consumer behavior has changed. Government have increased their spending. Businesses have changed their businesses in order to maneuver the crisis. So a lot of changes happening in the landscape. From a sectorial point of view, also, as you notice, some sectors has performed very well, and some of them are not. And within the segment of each sectors, there is some elements and the trend that has performed very well. And as a financial institution like us, we tend to really analyze the sector and try to identify the future trend that might change and try to deploy investment and promising opportunities. For example, we have invested heavily in technologies. In particular, for example, we have been deploying investment in online education. And this is something that we have deployed before the pandemic. And I give a credit to the team who have identified this future insight on that particular sector. So the pandemic have changed the landscape, but our philosophy remains the same. We remain as a long-term investors. We remain to really invest for purposes in a very diversified way.
Thank you so much. Steve, how do you see it changing?
Well, I think we're very much on the same page as QIA. We've seen just astonishing acceleration of trends. This is the world of disruption that we've experienced, and technology is the way to play that. So we've been fortunate that we made that pivot before the pandemic itself. And we've done all kinds of things to take care of, address that kind of digital acceleration. So, for example, we decided really close to a decade ago to emphasize warehouses, which are needed by the digital economy to ship things because they ultimately have to be delivered. And we've switched our real estate portfolio over time away from hotels and malls to life science type of investing and warehouses. There are no vacancies in those types of businesses in real estate, and big acceleration of rents. So we see these trends as enduring. Disruption now is something that every business model is being challenged. And the pandemic really brought that home. And so we're investing a lot in technology and green investments and all types of things that are reflective of the world that we're now living in. Much more growth investing over time. We call these good neighborhoods. And so we're very much thematic investors. And that's turned out to be really a wonderful approach for generating performance with capital preservation.
Your Excellency, you also were talking about trends being brought forward because of the pandemic. What about real estate? So does that change? Will we work more from home? Does it actually change some of your investments in some of the biggest capitals in the world?
Absolutely. As you know, real estate is one of our traditional asset classes, and it takes a component in our mix. Absolutely, when you see the pandemic has brought a subject between how the e-commerce will really impact the retail space, and this is challenging for the segment of the real estate. Working from home for the offices is also something that is changing, even though I'm a really believer that people will keen to go back to their offices, and I'm glad Blackstone have started to go back to their offices. But we are focusing within real estate on very sub-segment. One of them I'm sharing with Steve, the theme of investing in warehousing to really support the e-commerce businesses, which is a segment that we are deploying big time on that. The data center, for example, which is another segment that we think have a promising future, and very specific real estate. We appreciate the relationship with the Blackstone, and we have done co-investment opportunities in life science real estate, which is something used for research and labs on that domain. So you have to be a little bit very specific in analyzing the sector and to try to really find out what are the opportunities that you need to really deploy investment on.
Steve, are you aggressively now on the hunt for deals, and do you worry that multiples are just very high, and that will, mean it more difficult to find the right companies, the right opportunities along the road in the next 12 to 18 months?
Well, I think, Francine, you're right on point with that question. We've been in business almost 36 years, and so we've been through these periods of higher multiples, and it leads to a certain type of caution, but it also presents a lot more opportunities because prices are higher, more people will sell. What we've learned is because we're fundamentally in the private markets, is that the only reason to buy something is to make it much better. We're in the business of accelerating growth of companies and of real estate that we own. And so it's unlike stock investing where you buy it and you hope it works out. We're change agents. We believe for good. And if we can put more money to grow businesses, then we can deal with some of the issues of higher prices by accelerating growth, which gives us more protection on the downside. With the prospect of the United States potentially increasing capital gains taxes very significantly, it's really like an avalanche now of opportunities of people want to sell things before their taxes are much higher for selling the same thing potentially next year. And so it's giving us a lot of opportunities. And what we have to do is be careful, always have a very exciting plan for growth. By the way, that results in us hiring more people. So this is good for society, and hopefully it's good for our clients who typically are large institutions like QIA.
Your Excellency, how far along is the QIA in actually try to diversify its portfolio? So I know you've planned to boost investments, for example, in technology and healthcare. Is that done to a level that you're satisfied with now?
Not yet. I think we have been deploying and focusing in technology and healthcare. Within the last 2 years, we have deployed in technologies more than ever before. I think the sectors is promising, especially if you really targeted a certain segment within technologies. And I think it's the sectors have grown to stay. I don't think so. There is a risk, perhaps in the short term, with the inflation in mind. Even though I'm not really concerned about it, I think it would be a temporary basis. But as you know, it's the era of technologies, and a portfolio without a huge component of technology is not really a balanced portfolio.
Steve, I was also going to ask about inflation. Is there a danger that the U.S. economy actually overheats?
I think there is a danger. The U.S. economy is really on fire. Almost everything is growing much faster than almost anyone anticipated. We've had almost a perfect storm here of massive government spending, central bank accommodation, record low interest rates, and that's a recipe to really power an economy. In the United States, for example, we're looking at economic growth of estimates around 8% real. We're an economy that usually grew 2.5. When you go up to 8%, you are going to create all kinds of interesting things, one of which will be inflation, which we're experiencing now. This isn't a future concern. It's right on point, whether it's commodities like lumber or copper, anything that's used in housing. Wages are the most concerning because we did some things in terms of our stimulus plan with very large benefits for people and extended them, which was prudent at the time, but has turned out to be discouraging workers from going to work. So we have 9 million jobs unfilled and 8 million unemployed people. And we hope they're matching up, but it doesn't look like exactly they are. So some of this will be temporary as the economy starts up again and things sync up, not 100%. So there'll be shortages, people bidding up to get certain types of commodities or other products. But some of them, once you raise people's compensation to get them working in hotels or theme parks or other types of things, it's very difficult to reduce people's compensation. So I think some of the inflation will be baked in at higher levels than we've certainly experienced the last decade.
Your Excellency, do you agree with that? You seem to suggest that actually the kind of inflation that we'll get will be transitory. So what does it mean for your investments?
We mean this is, less risky for us. It doesn't mean that we are not monitoring the situation very closely, but we have a full confidence on the Federal Reserve in managing this, and they have proven that they have managed the pandemic time very well. And we are hoping that we will have a soft landing and managing the inflation.
Your Excellency, for a long time, the QIA was really associated with the so-called trophy investments, be it Barclays or Harrods and the LSE. Has that now changed? Is it a change in policy or investment strategy, or could we see big ticket investments coming back?
You could see we always believe in diversification and any exposure in any region. We always try to maintain a part of it real estate, part of it with the blue chip companies and some technology company. We always believe in diversification and have a great balance and mix that would manage our risk. So perhaps when we have an opportunities, you might hear us, acquire some businesses in the future.
Which, I mean, if you want to share the names now or something that you're potentially looking at, but probably not.
No, of course I cannot. Of course I cannot share any names.
Steve, there's such big amount of money, of dry powder in PE firms. Does it mean that we could be looking at new asset classes, that there are maybe even regionally parts in the world that were lagging that now can see a deployment of capital?
Well, what happens is there's always a lot of capital available for people who have high returns in the private equity sector, and basically the alternative assets have had superior performance over time, and there's more money. And what you look to do is not put all that money in the same strategy, because then you would end up with lower performance. So there's a constant search for new things to do that you believe would be good for your investors. And if you can't find those good new things, then you just don't go there. But we're finding that there are different rates of return that different investors want. And so we're doing more investing now around the world with rates of return that make retail investors very happy. Those may be somewhat different, with more emphasis on current income than a sovereign fund like a QIA may be looking for. And what we're finding is there's huge demand for current income with returns in the 10% area, and we're expanding rapidly around the world, providing that types of returns. Ironically, it ends up being a good thing for the higher return products as well, because sometimes we can buy a very, very large investment and break it into two pieces where it satisfies the needs of both of those different return funds. So we're finding global expansion is very much comfortable for us. We've got 28 offices around the world, and we're always finding something new to do, which, by the way, keeps me excited about what we're doing. It's always something new where we think we can develop very high returns or appropriate returns for investors.
And the QIA also had this pivot to Asia, or this tilt towards Asia. How is that going?
Absolutely. I mean, Asia, we have been very vocal about Asia and US. And we have been very vocal that we had a little bit of concentration in Europe, and we have been deploying for the last 2 years, mainly in Asia and US. So it's going fantastic, and most of our pipeline is dominated for these both regions.
Steve, how should we look and how should we think about sustainability? So there's definitely been a pivot towards more ESG factors when investing, more sustainability, especially in the last 14 to 16 months. Are we going to rebuild an economy based on that? And what does it mean for investors?
I'll get to that in a second, but I just wanted to finish up what Mansoor was talking about. Our largest returns in the world, our best returns historically have been from India, which is an Asian economy. So as he's saying, he's putting more money there. We found that's a very wise thing to be doing. As to sustainability, this is a trend that's been going on for some time. We hired a chief sustainability officer at Blackstone 10 years ago. And it will be a large part of the energy area. Of course, the world is pivoting in that direction. In the last year, we've invested $5 billion in those types of green technologies. There's a global focus on clean energy sustainability, and every business needs a focus there. I think, Francine, you're right that this is a new vertical in the investment world, and it's a good thing that it's happening.
Your Excellency, I wanted, before we get on to sustainability, which I know is something that you're also looking at very closely, do you have a target for investments in the US and investments in Asia over the next 5 years?
Yes, we have a certain allocation and exposure that we normally present to our board, how much we would like to invest in Asia, how much we would like to invest in the US. Hopefully, I mean, your pipeline and your finding opportunities will dedicate also how much you are deploying this. Some, as you know, some of our investment is also managed by a third party, like, for example, Blackstone. And we are trying to associate ourselves with the best-in-class asset management because we believe they are the engine of any economy and they are a generator of a lot of deals that will make us really or present us a co-investment opportunities to deploy more investment on that region.
Do you ever worry about being caught in the middle of a U.S.-China, trade war, or not getting, any easier?
I don't think so. I think the subject will remain for a long term. I mean, there is a fundamental issue between the two countries, and the subject will always remain. We are monitoring the situation very, very closely. And I think the two countries are mature enough to understand their consequences if there is any major disagreement. But apparently, the negotiation will take longer than expected.
How do you see this developing, Steve? And then I do want to go back to ESG, but how do you see the relationship between the U.S. and China developing under President Biden?
Well, you have to start out with the fact that the U.S. and China together are approximately 40% of the world's economy. And there are only two countries out of roughly about 185 countries. So you have about 1% of the countries with 40% of the global economy. So there's a need for these two countries to cooperate in a variety of areas. Setting up completely separated economies is really impractical. There are certain areas that are of enormous sensitivity between the two countries, which are mostly around technology. And I think that will remain as an area of focus between the two countries. There'll be more development of independent sourcing in that area. And I would anticipate that a lot of the other commerce will continue, much as it is doing currently, by the way.
How does the QIA actually look at purposeful investing? And what can you tell us about the energy transition? How do you see it playing out?
I mean, our philosophy, as I mentioned, it is investing with a purpose. And we're always satisfied when we invest something that it makes a return, it brings positivity to the market that we are investing in, and which is environmentally friendly. We have been investing in the ESG initiatives and the project for quite a time. But this year, it would be a little bit institutionalize our process, and we will embed our ESG into our investment process. We will have a policy, we will have a KPI. I think ESG is getting very important, and I think the momentum globally is there. Investors are looking to deploy investment, and government from the other side are being very receptive. Both parties are admitting that we have an issue globally, and I think there is a momentum and there is a tremendous opportunities in that space. Even within the technology that's supporting that space is tremendous. For example, we have been investing in energy storage facilities, and we think this sort of investment will help deploying more investment in renewable energy.
So we're almost out of time, but in 30 seconds, Steve, when you look at what you think investors get the most wrong, is it SPACs, cryptocurrencies, or is it the abundant liquidity in the market?
Geez, you have some really fascinating recent developments. There was several SPACs a day being created, and now there are almost none because the regulators have gotten involved, and some of those compensation arrangements for general partners were somewhat inconsistent with alignment with some of their investors. So I think that was an interesting thing where you have a lot of capital now looking for deals. As to cryptocurrencies, I leave that to Elon Musk.
All right. What about you, Your Excellency? What do you think the markets get wrong?
I think both subjects are premature, and they need time to reach maturities in terms of legislation that govern them. In terms of a SPAC, we have been dealing with them from the receiving end. So some of our investment has been targeted by SPAC, and it went very well. In terms of the cryptocurrency, we have not, we think we are, that space is in a speculation space right now, and it needs a little bit of maturities until we make our view about investing in that space.